Greetings everyone. Today I'm going to present my topic speculation with interest rate futures and under the subject international finance. So, interest rate futures are an important part of global financial markets and are widely used by investors and institutions for both risk management and profit making. First, let's understand the meaning. Interest rate futures are standardized financial contracts whose value depends on future interest rate movements. They are traded on organized exchanges across the world. Speculation means taking position in these future contracts to earn profit from expected changes in interest rates rather than to reduce risk. This topic is important in international finance because global interest rates influence investment decisions, capital flows, inflation, and economic growth. Investors across countries closely monitor interest rate changes to earn profits. There are some important features of interest rate futures. These are standardized contracts traded on exchanges and are usually based on government bonds, treasury bills, or interbank interest rates. There is an inverse relationship between interest rates and bond prices. When interest rate increases, the bond prices fall. And when interest rates fall, the bond prices increase. If a trader expects interest rates to fall, they take a long position in futures. And if they expect interest rates to rise, they take a short position. So speculators make profit by correctly predicting interest rate movements. So now let's understand its mechanism. First, investors analyze global economic conditions such as inflation, GDP growth, and central bank policies. Then they predict whether interest rates will rise or fall. Based on this prediction, they either buy or sell interest rate futures. They deposit a margin and their profit or loss is calculated on a daily basis. For example, if an investor expects interest rates in US to fall, they buy bond future at price 100. And if the price rises to 105, they earn a profit of rupees of dollar 5 points per contract. And if the prediction is wrong, they incur a loss. So let's see some practical relevance with an example. In India, interest rate futures are traded on exchanges which are listed like NSE or BSE. Their value is influenced by policies of Reserve Bank of India. If investors expect RBI to reduce interest rates, they buy interest rate futures because prices may rise. And if inflation increases, RBI may raise rates and investors sell futures expecting prices to fall. Banks, mutual funds, and institutional investors actively participate in these markets. Thus, interest rate futures reflect market expectations about inflation and future RBI policies. There are some advantages of speculation in interest rate futures. They provide high liquidity and allow traders to enter and exit easily. They offer profit opportunities with low initial margin due to high leverage. They also help to in efficient price discovery in financial markets. However, there are also some limitations. Leverage can increase losses. Interest rate markets are highly volatile, and unexpected economic or policy changes can lead to sudden losses or margin calls. To conclude, speculation with interest rate futures allows investors to earn profits from expected changes in interest rates. It plays an important role in global financial markets by improving liquidity and reflecting future economic expectations. However, it involves high risk and requires proper analysis and decision making. Thus, interest rate futures act as a powerful tool of speculation in international finance and connect global monetary expectations with financial market movements. Thank you.